Welcome back to the channel, everyone, because today we have to be completely honest and direct about something that people keep circling around without ever properly breaking it down in a clear and accurate way. Quantitative tightening officially came to an end on December 1st, and the question flooding the space right now is identical everywhere you look. What does this truly mean for XRP? Not the fantasy interpretation, not the hopium-fueled convention-level theories, but the real data-based, historically repeatable explanation. This is the first time I am introducing an entirely new combination of tools, charts, and long-cycle macro data to explain this clearly. And if you actually care about where XRP is headed over the next 24 to 36 months, you need to hear this exactly as it is, because it is time to cut through the nonsense. The market is not collapsing, it is not broken, and it is not being manipulated into extinction. What we are seeing right now is precisely what every major macro cycle has displayed before: price responding to moving averages and shifts in global liquidity. XRP did not suddenly collapse because belief disappeared. It began its decline at the exact moment price fell below the 50-week simple moving average, the same technical signal that marked every previous XRP bear market bottom. And the moment quantitative tightening ended, intelligent investors immediately stopped asking what is happening now and started asking what the data shows is coming next. Here is the reality most people avoid acknowledging. History is repeating with uncomfortable precision, and denying it is nothing more than emotional self-protection. The break below the 50-week SMA is not random noise. It is the same early warning signal seen in 2018, again in 2021, and now once more in 2024. Until people stop obsessing over short-term price moves and start analyzing the macro triggers that actually drive cycles, such as QT endings, liquidity reversals, stimulus resets, and monetary expansion, they will continue to be blindsided. Today, I am going to walk you through what followed every prior QT conclusion and what XRP price behavior suggests is coming next. If you want real answers instead of comforting fantasies, you are exactly where you need to be. To understand what comes next for XRP after quantitative tightening ends, emotion has to be removed from the equation and replaced with structural analysis. Markets do not move because influencers shout bull run or because social media sentiment suddenly turns positive. Markets move when liquidity conditions change, and those conditions just experienced one of the most important turning points since 2019. QT, the deliberate removal of liquidity from the system, stopped on December 1st. Whether XRP holders recognize it or not, this shift has historically been the opening phase of every major crypto expansion. That does not mean instant upside, and anyone promising that is either uninformed or intentionally misleading. When XRP's chart is examined objectively, the pattern repeats with uncomfortable consistency. Every major bear market bottom starts with a breakdown below the 50-week simple moving average. XRP fell below it in 2018 and bottomed months later. It broke below again in late 2021, bottomed shortly after, then entered recovery. And once again, XRP fell below the 50-week SMA in October 2024, the same month Bitcoin lost its own 50-week support. There was no mysterious force pushing prices down. It was macro liquidity and technical structure behaving exactly as they always have. Once price loses the 50-week SMA, a 5-shaped recovery does not occur. Instead, a sequence unfolds: breakdown, panic, base building, relief bounce, rejection at resistance, and finally the true macro bottom. XRP has not finished that sequence yet, and expecting it to behave differently is simply an attempt to bend reality to emotion. The bounce has not occurred because the structural bottom has not yet formed. That is what both the data and history clearly show. Bitcoin follows the same rule. Every bear market bottom in Bitcoin history formed after losing the 50-week moving average and before the next phase of monetary expansion. Now consider quantitative tightening itself, because this is where macro forces and XRP intersect. The previous QT cycle ended in July 2019. What followed was further downside, collapsing sentiment, and widespread declarations that crypto was finished. Then QE was announced, and Bitcoin and XRP launched into one of the largest bull markets ever recorded. Not due to magic, but because liquidity returned. QT ending is not bullish by itself. It stops the bleeding. QE is what ignites the rally, and QE never arrives immediately. There is always a delay, historically between 12 and 18 months, which places us squarely into 2026 for the peak of the next major cycle. People dislike this reality because it destroys the fantasy that 2024 or 2025 will produce immediate all-time highs. But markets do not care about desires. Liquidity determines outcomes, and liquidity expansion is not here yet, but it is coming. When it does, XRP will not be sitting at current levels. The phase after QT ends is historically where assets complete their macro bottoms. Charts look lifeless, sentiment collapses, and investors exit from boredom rather than fear. That is the environment forming now. The frustration traders feel is actually one of the most bullish long-term indicators available, because bottoms never form during optimism. Once XRP completes its bottoming structure, the rebound historically becomes aggressive. Look at 2018, look at 2020. Every time price reclaimed a 50-week SMA after losing it, it led directly into a bull market expansion. Combine that with QT ending, projected rate cuts, and the near certainty of QE once economic stress intensifies, and the setup mirrors every prior major cycle. The difference this time is XRP has ETFs, institutional custody, regulatory clarity, and real-world utility actively rolling out. Yes, price may go lower before rising. Yes, a relief rally will occur. And yes, the real explosive move only begins when quantitative easing officially starts. Everything before that is positioning. Now let's confront what people avoid hearing. Market psychology is what will define the next phase. People are frustrated not because of price alone, but because expectations were unrealistic. They expected a multi-trillion-dollar financial system shift to unfold in a single cycle. They expected ETFs, CBDCs, QT endings, tokenization, and macro crises to instantly pump prices. That is not investing. That is wishful thinking. Macro transformations operate over years, not social media timelines. If that reality is unacceptable, then this market is not for you. XRP is currently positioned to remove participants without patience or conviction. Institutions accumulate during fear, not excitement. They buy when charts look broken and headlines turn negative. XRP is in that zone now. ETF issuers, custody providers, and financial institutions do not wait for retail confirmation. Bitcoin dominance will not fall while liquidity is tight. Bitcoin always leads early, absorbing liquidity first. Altcoins move later after expansion begins. Expecting XRP to outperform Bitcoin during contraction misunderstands macro mechanics. QT ending is the warning shot. Expansion comes next, but not immediately. Relief rallies may occur. Deeper drawdowns remain possible. Until QE is announced, rallies serve institutions more than traders. Markets reward discipline, not emotion. XRP follows the same pattern every cycle: frustrate, compress, bore, then explode. If you cannot endure the first phases, you will not experience the last. Markets are designed to transfer assets from the impatient to the disciplined. XRP exemplifies this process. On-chain data shows exchange balances dropping. ETF demand is rising. Institutional flows are increasing while price remains intentionally dull. This is accumulation. Manipulation exists, but not as retail imagines. It is about sentiment control while supply shifts hands. Alt season has not begun because liquidity has not expanded yet. That comes after QE. Retail often exits just before that phase. Charts are engineered for maximum frustration before maximum expansion. ETF inflows, tightening supply, macro reversal, and institutional positioning are aligning. The only remaining question is whether you have the patience to remain positioned. The biggest enemy is not the market, but impatience. Confirmation always arrives after opportunity disappears. When liquidity returns, the move will be fast and unforgiving. The data, structure, and institutional behavior all point in the same direction. QT is over, expansion is next. Positioning happens now. This content is for educational and informational purposes only. It is not financial advice. Always conduct your own research, assess your risk tolerance, and consult qualified professionals before making financial decisions. Crypto markets are volatile, Never invest money you cannot afford to lose.